Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for what is it now? Wednesday. Sorry, I've been scrambled the last couple days, having to run out of town to take care of that passport issue. It's Thursday, guys. I'm sorry, Thursday, June 6th, 2024. What I'm going to cover in this video, we're going to start out with the equity markets, do a brief update there. Reiterate my trading plan, then get to the an update on the metals, the miners, which I just updated day before yesterday, right before I left town, but I'll give you another update there. The grains, starting to re-engage the grains, as I told you today, and as I said, I most likely would last night. Brief update on just commodities in general. I want to look at DJP and the whole inflation thing, and then the other commodities, natural gas and crude oil. And then that's quite a bit, but time permitting, I'll get into some of the sectors that I've been highlighting recently and focused on. That includes the semis, the broker dealer index, that's IAI, financials, regional banks, retail sector, and even shipping. If I have time, I'll get to that. That'll probably be a second video. So let me just start out with, I'll go in the order I just told you, starting here with the equity markets. And so that was yesterday when I was out of town. We made that marginal new high, as I said repeatedly in recent videos over the last week or so, really since we put in these bearish engulfings, which I still consider objective short entries. That was on those bearish engulfings were put on May 23rd. So due to the nature of the markets, just my observation and experience in recent years, I didn't say fully, but I definitely anticipated and said I would not be surprised for them to run up, pop that high, because that's what they, meaning quotations, do. That's the, algos, trading firms, who have a tremendous amount of capital to move markets. And either way, it is or isn't, I think, and I said before it even happened, if it happened, it'll be a great stop raid. So here it is. We didn't, we went in, we took out those previous highs by less than 1%. So we're talking a fraction of percent basis points. And I mentioned, giving it a couple percentage points above there if you want to try to, park your stop loss order out of the range of the stop rates, any potential stop rates. Me personally, so I'm telling you my trading plan, I'm still sticking with this now. We'll see how we close today. We'll see if we keep those PPO sell signals on tack. That's the bearish crossovers recently. Remember, this is a daily PPO, so all that matters is how we close the day. So today will be interesting. Tomorrow's Friday, last trading day of the week, and last trading day for me in a while. So, telling you what I'm doing. I'll make a decision then. Today, we're flattish, and I don't think I'm going to do anything as far as that swing position. Again, the most recent short from back that on those bearish engulfing candles, which again has not violated, at least the suggested stop based on my trading plan yet. So we'll see what happens, and then of course the trend indicator, we'll watch that, and then tomorrow, that's it. We take off. We're going to Italy. 10 days, going to be gone. Monday, we fly out early Monday, the 10th. That's this coming Monday. Returning back, I think it's the 20th. I don't know if that takes us into the 21st. We have to fly out across the state. Got to go back to Miami again, where I just came from, 3-hour drive. So I will update you at one point or a couple points during that. We're going to be, got a lot packed in on, we're going, doing a lot, seeing a lot. So it is summer doldrums, and half of you listen to my voice. Well, if you're listening to my voice, you're probably not listening to my voice if you're on vacation. But I know this is when people tend to be on vacation with families and all that. So, like I said, any important updates, I'll make a point to, even if it's, I shoot something out and it turns out to be 3 a.m. your time. I'll try to get you a couple updates when I'm gone. So that's it for now. I'm sitting tight. We'll see how we close the day today, and that's that. So we're, like I said, ever so slightly above where we peaked on those bearish engulfings the other day. 0.5% higher, and that's after going less than 1% above those all along. So again, still within the trading plan to allow a little bit for potential stop rate there. And the same thing holds true on SPY. SPY did the same thing, marginal, ever so slightly pop above. Could be the real deal. Has the potential to flip this trend indicator back to bullish. has the potential to build on those gains and even, take a little bit, but has the potential to wipe out the big divergences that have been building for some time, but it hasn't done so yet. So let's look at QQQ. Let's go down to a 60, just see what that tells us. This is my go-to swing trading time frame right here, and that's as far as I can scroll back, but you can see the annotations. That was a RSI divergent low right there. There was a divergent low, divergent high, all the simple stuff. Divergent high swing. We had a target there, divergent low right there, rallied, and again, there's multiple. These are overbought conditions right here on the RSI, and red is overbought, and the purple line about 80 is extreme overbought. And right now we just hit overbought there. And all the better, what you tend to do with overbought, I always say overbought is not a buy or sell signal, just like divergences aren't a buy or sell signal, they're conditions. And now in a downtrend or an uptrend, my preference is to not see, sometimes you get a one and done overbought, but is to see a series of lower overbought readings, and i.e. that is the definition of negative divergence. So that's what you have right now. You had a divergent high. No, you did not have it here. You only had it starting here on both indicators, the RSI, and we started it here on the PPO, and that's it. So if we turn down and close red today, again, big if we go green, we can burn through these divergences. We have the first negative divergence on a 60-minute time frame since right here, and that was right when we shorted the previous Fed meeting, not the one that just happened, the one before that. We shorted that pop the day after, milked that 8% run down. That was right into T2. So I just wanted to say that this is, at that point, that divergence right here, the way I have it drawn, I'm going to move that away. Why am I doing that? That line should be moved because things have changed since then, because we made this higher peak right here in the RSI right there. And that was above the previous peak. So this is the divergence I just drew for you on that different board right there. And that is, and we'll just take it, let me just remove that line from that point from here to here. So that's it. And will it play out? I think so. I suspect so. It's part of kind of what I was covering before it even happened a week ago, that hey, they probably might come to, that's that previous high right there, try to pop that high, and if it fails, the divergence will then be confirmed, and it will also be a failed breakout, and the PPO trend indicator, which I've covered many times in the past, a pretty good reliable trend indicator, will stay bearish. Then you still have this uptrend line to contend with, and then we go back to the same targets. It's like I said, it's either a new trade there, new trade for me, having covered back there, and then there was a trade there that failed, got stopped out right there with a pretty much a partial entry anyways, and then this was the new most recent trade, and those are the same targets for some of those that might be in that longer term trade there, and that's coming down. The 200 days have ticked up a bit since I first put those targets out there. I still think they'll be hit, but I also still think what I said would happen back then. I think when we go down, we're going to slice through them either that day or the following day, and then come on back and probably test them or park on them. So I still favor, I just want to clarify, nothing's changed. I still favor at least T3, and that is the next target. We'll see, and we'll go from there. And quite likely a punch down to maybe T4, T5 when the turn comes. But for now, what you need to see, I can just say this really clearly. If I had 0 positions, there's no objective trade to be made right now. There's a trade to be, if you're sticking with a trading plan like I am, trade to be in, but there's no reason to short or add to shorts. We just punched out to new highs yesterday, right? So what you want to see is that new high breakout fail, come back down below the previous high. You want to see, it'd be nice to see this PPO stay red, which it would if we close down red today, substantially red. Like I like to say, the redder the better. And then this high right here, that's an even bigger level to see fail, 1449. So I'm going over the levels right there. The first one would be back down below the previous high, the bearish engulfing candle, and then we almost tested it there, about 460.15. So support 1, support 2 is this uptrend line, and then support 3, 449. Let me color those up. Yellow was the important level down there. I'm going to color these. Let's just make them blue so they stand out. So I'll certainly be able to give you an update, at least one more before I leave town. But there's the levels to watch. 1, 2, 3. And if you are trading the other side of things, you're a glass half full guy or gal right now, then these are levels that you can buy pullbacks to if you're looking for objective levels to add. Yeah, that's it. So the trend line of 449 come in roughly together. SPY, SPY, this is a daily time frame. Same story. Red today. We've got the divergence, the bearish PPO crossovers as a trend indicator. This is a 60-minute chart. So if you're a SPY trader, remember we did the day of the bearish engulfing candles. Again, this is on a 60, so you're not seeing them here on this chart. You put in a divergent high. You had a correction. Drop down there, and this is a nice clean up trend line, and we hit it the other day. I've showed this one previously, and now this is our new minor downtrend line. So the way this works, the divergence we had in place back then, the day of the bearish engulfing candles. I'm sorry, again, note that starts. We only had it on the PPO there. This is new divergence. It started that day right there. You can see on both indicators. So again, let me be clear. Let me draw it down here from this point here to this point here. So we have the lower highs on the indicators there to there. That is on both indicators. That's what I prefer to see. And the last time we had it was right here. It ended at that point. We put in a divergent high. Market tried to go and make a new high, made basically an equal high, extended that, and then that was followed by the that big correction there. So almost an identical technical posture. And again, the first time since a month. It's been over a month. That was back in the beginning of April last time we had a 60-minute divergent high, and it was also new highs too. Same thing. Market cheered the new highs, and they're turning the new highs now. So that's that. Here's gold via GLD, the ETF. Remember, we're coming off that divergent high recently right there. Then we took out the trend line with a solid red candle, giving it a sell signal. The day before I left, which was, what's today, Thursday? That was Tuesday. I mentioned covering my silver shorts. I'll get to silver in a second, based on the futures, which I trade. And that was right here. Very timely exit. Some of you may have gamed it for a bounce or added to. I think one person even said they were going back into their silver, gold mining stocks or gold trades. This was silver. It was price support there. Positive divergence. And as I said last night, I'm not eager. I'll let you know. I'm watching and waiting for the next objective entry, be it long or short. But I can tell you right now, as I'm doing this video, we're at resistance, price resistance. It's not a super duper resistance level. And this is a pretty powerful, this was pretty big divergent low. Last time we had bullish divergence was right there on the 60-minute chart. I believe that was mentioned. I believe we went long on that one, or was it the previous one, or both? And that's silver. Remember, silver is going to follow gold. Gold of the two is more important. And that was, this was gold. So gold on Tuesday, when I mentioned, we were right there. Hit that key uptrend line. We had a positive, aka bullish divergence. So there was every reason out there, in my opinion, to cover those, at least cover. Well, that's what I did and told you. And you guys can do what you want, but it's when you get the positive divergence, even though we are coming off, as I said back then, we're coming off a bigger divergent high. So I suspect this rally is going to get sold into. It's a it might have some legs, and what I did is I added some resistance levels. The thickest one up here, 24.34. If you take that out, you're probably going to go to new highs, or at least test those previous highs. So far, you have almost a double top. It was a slightly higher high. Again, put in that divergent high in gold, and but the buyers stepped in where they should. That's a well-defined trend line. And so, nice move up in gold and silver today. But again, to me, it's part of the fact, I'm keeping things relatively light. I did re-engage for the first time in a while the ag commodities today, which I'll get to, the grains. I'm going to get to those in 1 second. Kind of just on wait and see to re-enter silver short for the time being. And that may not happen, if I don't know if the Wi-Fi is good on the plane. I'm, a long flight out there on Monday. I'll post some updates and get some things out to you if I see anything I like. I just, personally want to keep things kind of light over the next couple of weeks, not being able to be around in front of a computer or even, awake during most trading hours. And then GLD was also on Wednesday at that support T3, which was hit. So you had the divergent high, trend line break, T1 hit, T2 hit, T3 hit with, again, positive divergence. You just can't, stay aggressively short or get short, or if you want to game a quick bounce, and that's what it was. And now look, we're back to S2. S2 meant for a second support level. First support was the trend line, S1 back then. And now that's too far for a back test. You back test it, you're going to new highs. So that and this level, this is, I think, comparable to what I just gave you on the gold futures right here. I'm going to brighten it up a little bit. It's a line I had there, 221.88. Again, this is where if the bounce is going to get capped and we're not going to go to new highs, that's probably where it's going to be. But again, it's hard to, these divergent lows on the 60-minute in a bullish trend are typically the catalyst to new highs. So, I said it then and I'll say it now. Convictions aren't very strong, but certainly we're strong enough to cover those shorts on Wednesday. I'm sorry, Tuesday. Or the silver mining short. I've still got some silver futures. I'm sorry. I've still got a couple silver miners on that I'm going to give some room to because I do believe there'll be another leg down. Nothing crazy. I have plenty of room to add to those. So that's my plan. And I'll leave town with stops in place on those. I'm not going to give them too much room. Okay, now what I'm going to segue into here is related to both gold and silver as well as the stock market. I haven't covered it in a while, only because the charts haven't been so clear, but I think today's a good day to update you on the euro-US dollar pair. I cover that really as a proxy to the dollar. I don't trade the euro. I'll be buying and selling things in euro for the next couple of weeks, but for the most part, I watch it to help align my analysis on both gold and silver as well as the stock market. I'm going to show you that in 1 second. Well, let me start there. Let me just show you what I'm talking about here. This is a 60-minute chart, and I'm going to type in FXE. FXE is the Euro ETF, ETN. Excuse me. And you can see here there's a very clear and unmistakable correlation between the stock market and the euro. Now, and that's just because the euro is the biggest component of the dollar index by far, not even a close second. The yen's the second largest, and it's only less than half the weighting the dollar index. So the euro is basically the dollar in reverse because of that. And you can see what I have here in white is FXE. Now, I use FXE because that's an ETN and it trades 9:30 to 4 p.m. just like SPY, which I'm comparing it to here, which is the S&P 500. Otherwise, you get the EUR USD is trading 24/7, and so the lines are going to not line up, match. So I've said it before, whether it's the tail wagging the dog or the other way around, nobody can deny the unmistakable correlation there between the two. Look for when they top, when they bottom, when they're both trending up, when they're both trending down. There are brief periods of disconnects, like I just right there, that one. But other than that, you can see they're both moving up. They both turn and they both move down. They've both been rallying lately, right? Hard to argue. You can't argue that correlation. So therefore, there is some, call it predictive value in trying to chart the euro US dollar and see where it's going. And also, of course, let me just show you that's the S&P 500. We were just talking about gold. And again, very, very strong correlation between the euro and gold. And, simple stuff really on both. You can see the core. Look at the peaks and the valleys and the turns in each of these, unmistakable. There are times where there's brief periods of disconnect, and that is due to either overwhelming supply demand dynamics in gold. In other words, this correlation I've explained in the past is very, very simple. The gold we're trading, I'm trading gold futures. You're trading, if you're using GLD, if you're buying Costco's gold coins, you're buying gold in US dollars. So when the dollar is stronger, it takes fewer dollars to buy an ounce of gold. And when the dollar is weakening or going down, it takes more dollars to buy an ounce of gold. So that's why that's an almost nearly immutable correlation because of the simple mathematics right there I just explained. Now, there are times where there's an overwhelming demand. Even the dollar could be going up, but the gold's still going up because if everybody's buying it, such as breakout or whatever reason, yeah, you'll see a brief disconnect. And same thing with the, like I said, the euro in the stock market. But now that you can see that correlation, how clear it is, let me go back to it and let's chart the euro and see if we can figure out where things are going here. So again, we'll use EUR USD. You can use the dollar index if you want. Just have to look at it upside down. All right, this is a weekly chart. This is the longest term time frame you can go. At least I can roll back to here on the EUR USD. And there's my primary secular bear market downtrend line. That just means over time, the euro is depreciating against the dollar, dollar's strengthening against the euro. It's just the way it is and has been. But that's very long term. You can see a downtrend line here, more near term, which I'm going to jump down to on a shorter term time frame. So we're at resistance. That's the weekly chart. We're at resistance. We go down to the daily chart, and there's that same downtrend line I just added here, right there. So what I can tell you definitively is that the euro-US dollar pair is at resistance. Really, I'm surprised. Maybe it was priced in. Unless it's a false headline. I read that the ECB just cut rates, further kind of differentiating what they're doing in the U.S. We went from 7 rate cuts to 6, 5, 4, 3. Now there's talks we might not get any this year. But yet the ECB just cut rates, and it doesn't seem to really be impacting the euro. This is a 60-minute chart when I jump down to it again. So what you want to watch for here, look, if we break out the primary downtrend, let me change it. I know I fly through these charts pretty quick. We'll make it purple. You can see it really well, and we'll make it big and thick there, right? All right, so you're at downtrend line resistance. As I like to say, resistance is resistance unless and until taken out, right? So that means the odds favor that you get rejected there. If it breaks out, then that's going to be bullish. You got reaction highs that you want to see taken out afterwards. But what we have in addition to resistance, being at resistance, we also have an divergence line right there. This is negative, i.e. bearish divergence right there. The last time, and I highlighted it back here at the time, we had a divergent high was right there on the euro. And you can see what happened. We had a trend reversal. Euro was strong. It was rallying. Because of that, that means the dollar was going down, which means the stock market was going up. This is, remember, rising EUR USD. It's a falling dollar. That's bullish for the stock market. When this goes down, the dollar's going up, and that's actually bearish, just like for gold. And so there it is. So this tells me, based on the negative divergences here on the daily chart, the fact we're at downtrend line resistance, and I zoom down to the 60-minute chart, and I also have my divergence there as well. That tells me there's a likely trend change coming in the euro US dollar, which would mean the same for gold and the stock market if that historical correlation holds true. Where to? Here's an uptrend line right there, which is a potential target. So what you want to see is, number one, a rejection here. That's the long-term trend line. You don't see it on my 60-minute. Comes in there. Then there's support right there, and then this uptrend line. If you power on through there and you go on, you take out the divergences on the 60 and daily, and you take out the trend line, well, guess what? We may be looking at, we're probably going to look at more upside in the euro, more downside in the dollar, and that should be net bullish. And if you wanted real quick, you say, okay, Randy, let me trade the dollar. Give me some analysis on the dollar. There's the dollar. Dollar's UUP, dollar index. I haven't even charted it because I don't trade UUP, but not a whole lot here. What I would look at is on this 60-minute chart. I can't even get a good downtrend line. So yeah, just have a better read. I'll tell you, there's some price support there, right there. And that gives me a descending triangle pattern. And so if it breaks to the downside right here, then that's going to be the dollar falling. If it breaks to the upside right there, dollar is going to rally. And again, I just don't have this chart marked up. I just have the euro US dollar because of that trading 24/7, just like the stock futures. That's why I like to not only trade them, but also chart them, even if I were to only trade QQQ or any of the index ETFs. Oh, you can also see we took out that downtrend line recently there. So either way, the euro US dollar is where my focus is, and I already showed you the correlation there. So, and again, watch that, and it'll help either confirm or refute, hopefully, your analysis on silver and gold and the stock market. Okay, next up, grains. The grains are really a trio trade, I like to call it. Wheat being the primary trade, and corn and soybeans an ancillary or add-on trade, or adjunctive trade, whatever you want to call it, because the grains tend to run together. And so it's the same, and because they move together, those three, wheat, corn, soybeans, they used to even be in one ETF called JJG, which the company no longer has. It just didn't have enough, I guess it didn't have enough interest. But just like if you're, when you're trading the miner, when I'm trading the miners, is one of two things. If I'm bullish the miners, I'm going to not pick just one gold mining stock or silver miner. I'm going to shotgun, do a shotgun approach and buy at least a handful, the most bullish charts, or I'll just go with GDX or FSIL, the silver or gold mining ETFs. Why? Because I don't want to pick the one that just happens to lag, even though the sector moves together. So I do the same thing quite often with wheat. To be bullish on wheat and corn is to be bullish on corn and soybeans overall, because again, they have that high correlation. And that's it. So there's that T1 level. I'll just do a brief update because I covered this for you last night. I've been covered it in recent videos. I told you I got out of my grains there around when T3 was hit, because we had the negative divergence, and that increased the likelihood of a pullback. I told you I was waiting, wasn't feeling it. But if we got down to 607, I think that'd be a good reentry point, because it was really good resistance before we broke out. I was saying it was good resistance, and we'd run when we broke out before we broke out. The fact we did and we ran, it was impulsive. Then we came in and back tested, had another run up. It further validates it. It doesn't guarantee we'll bounce, but it guarantees to me that is former resistance. Once broken, then becomes support. So that's it. Not overcomplicate that. And then the other ones, the grains, corn, soybeans. Remember, same thing. We hit T1. First target on corn from back here, wherever we took it. These are still the additional longer-term targets. It's both a swing and trend trade, long-term trade, and then soybeans as well, SOY beans. Corn's up nice at 2% today. Soybeans are up 1.7%. Again, T1 was hit. Had some consolidation there. They couldn't get through it. Pulled back, and it's just kind of working its way up. It's not a clear uptrend line, but so far, remember, it was long-term support, and so far we have all the makings of an uptrend simply defined as any security making higher highs and higher lows. So in the fact that we had quite a bit, we hit T1, we consolidated on it for a week or two, and had that reaction, increases the odds next time we can go up through there, especially once we do punch through it, that it should open the door to these, at least the next target, if not all of those additional targets. And at the end of the day, again, it's a way to diversify, not just among a different trade or different security, but a whole different asset class that could care less what the stock market's doing or what anything else is doing. All right, let's segue over to the other commodities. We have crude oil, USO. If you recall, on my USO daily, I've had this trend line here for a while, uptrend line, which was just hit along with this 70.51 support. We have fallen back out of the yellow zone, which was support here. The yellow zone is where the stock market starts to take note. Orange zone is where the stock market really starts to take note, again, of crude prices, crude being like I said, the single best real-time inflationary indicator out there, by far, no close second. Real estate's big in there, but real estate's lag. The data, you can't tell day to day what rent owner equivalent rents are doing. That's what's included in the CPI, but you can certainly see what crude's doing. This rallies, you're quickly going to see it priced into the pumps, and therefore, so it's also has one of the biggest weightings in the CPI. So it's the best thing to watch for a day-by-day, tick-by-tick kind of update on what's happening with inflation. Again, it's not all-inclusive, but it's something worth watching. I'm going to put a little downtrend line right now. I'm going to take that away. I was just playing around with it. Either way, I want to say to hit that support level. I watch these zones. We'll go over here to this comparison between edit chart properties. Let's compare USO to the stock market and turn off gold. And you can see USO is in white. When crude rallies, especially when it gets into those yellow and then the orange zone, like I talked about, the stock market doesn't like it. That's no bueno for the stock market. Once it becomes clear to the stock market, the crude is reversed, correcting. Remember, we had a short on it back there. It's either a hedge to index positions or a pure play. The stock market loves it. Lower crude. But guess what? The crude starts going up. And then when they realize it, stock market, we don't like it. Crude's going up. Inflation's going up. But then right then, crude peaked right about the time the stock market finally got the memo that crude was going back up. And crude's been falling. So the stock market said, okay, we're good to go. But now we're rallying. Again, maybe too early to call it a trend reversal, but it's something to watch. So, and again, I made this. I don't think it could have been any easier. Did it with treasuries. You have your zones, and so just watch this. Crude gets back in the yellow zone. Stock market should start taking note. It's not an all or none binary thing, meaning if it crosses 74.08, all of a sudden the market's going to crash. No, it's every tick higher. More and more will become cognizant that crude is again going up, and so that's it. All right. And natural gas, UNG, I'll go to 60. I always say best align the targets with those on NG. Natural gas, or UNG is an ETN that's tracking nat gas futures. So, if you have the abilities, skill sets, whatever, to trade futures, you're going to track nat gas better. This, like all ETNs, has expenses, slippage. They're dealing with all that other stuff. But, you could still, it was not bad. It did a good job of tracking. We were long off the lows there, and it rallied up 55%, which is about what the futures did. Pop. Targets hit that downtrend line. And we re-entered recently. Again, that was the final near-term trade. I gave you a longer-term target on futures for those interested, which I'll still maintain. I told you this was just a correction that we're going to get because we put in that divergent high. And we came back to the uptrend line where that was the new entry last week on UNG natural gas, or the futures, up already 13%. So we made, on the first one, get in, get out, quick 35% or so to T4. Sidestep. Some of you might have shorted it too. Shorted some of that pullback there. Add a little more to that trade and then recycle back in. That's swing trading, active trading. And then we'll look at the futures. All right, so that was it. There's that's the trend line I just added for you. That's what's that? Oh yeah, that was the last entry back there. Yeah, I believe that was the entry. Yeah, most recent, right? We went up. Yeah, we hit T1, T2, T3. We had a little divergent high, pulled back. And now we have this trend line. That's what I added for you today here. And I put in the targets from before, T1, T2, T3 hit again. Wanted to point out when we hit T3 again, we came close enough there to effectively hit it. And that counts. We hit it again today and had another reaction off there. The divergence that we had last time we hit it has grown. It's even bigger. Not crazy about that, but remember, I've said it before during this, that natural gas tends, remember, we're coming off a much bigger, powerful divergent low. So this is near term, and the nature of natural gas is it can burn through these divergences. A lot of times they'll play out for at least a consolidation or a pullback. But all I can tell you is what I said this morning when I got this out to you. If you're bullish, you can use that to buy pullbacks too, the trend line. And you can also use it if you're long on natural gas, long nat gas, to put a stop somewhat below if it's taken out, because that will most likely take prices down further. And if you're new to the site or you missed it, this is the one reason, for being long natural gas. This goes back for years. Highlight these. I have on here, you can see all my divergent highs. These are divergent highs and divergent lows. And I put up a measuring tool. I've covered this quite a bit, including recently. We went long recently off nat gas at the lows because it was at these previous reaction lows, which is pretty much the historic low. That's about as cheap as natural gas gets. And as I said, it's a commodity. It's not going to declare bankruptcy, file Chapter 11, have any kind of shenanigans going on. So, your downside's pretty limited when you're buying that gas, under the $2 mark. But anyway, you want to look for, you don't buy it because it's cheap. You look for these divergent lows. I measured them out. Now, I'm going to say this measuring tool, this is stockcharts.com. What they use is they call it the continuous contract, which is looping all the futures. Remember, futures are going to roll in that gas. You have monthly futures. Stock indexes are quarterly, but they're rolling those, and they kind of splice the data. We went long. It didn't go down to 150 or maybe it was. We started with the Mays. We're in the July contract now. We rolled into the Junes, and the latest trades on the July. I just want to say I measured it out on the futures we traded in the UNG. It was about a 55+% run. This is reporting 112. So I'm measuring again from the bottom to the top, just using Stock Charts measuring tool. So all I'm going to tell you is take these numbers with a grain of salt. I don't know what their methodology is or why that might be off, but this divergent low measured from the low to the high right here, 224%. This one here, and if you go back, we were along many, if not most, or even all of these. Divergent low there, 160% to the high. Divergent low right there, 234 to the high. Divergent low there, 208% to the high. Divergent low here, 563% to the high. So far, this is saying 112. Again, I'm not, you can go back and try to see why this one's off. But the gist of it, okay, you're looking triple-digit gains off these divergent lows on the daily chart, and so, and just you can look at the scope of the runs and say this one most likely has some more traction, some more legs to go, and that's why it's a longer-term trade. But being the swing trader I am, when we get up there and you're at price targets and you've had a heck of a run, and you're at resistance, you're going to get these corrections along the way. And I've traded natural gas long enough. I told you I call it the widowmaker. I don't want to sit and ride out a 15-20% correction, even if I'm trying to capture a 200% trend. If I'm pretty confident we're going to get one of these, then I'll game it on the short side, or I'll sidestep it on the long side. Close the longs, wait for an objective reentry. But I just wanted to say that this, we're coming off both very low end of the range, and according to the previous rallies off the divergent lows before all was said and done, it looks like this is only just getting going. Not to mention, we're still in an inflationary environment. Given the rate of inflation, it's not hyperinflation as it was a year or two ago, but we're certainly, and let me get to that right now. That segues into the next thing I wanted to cover. So in the past, many times for years now, I've been covering DJP as a proxy for commodities. DJP is tracks the UBS commodity index, IPATH, Dow Jones, UBS commodity index. So it's all inclusive. It has a lot of different things in there: energy, grains, oil seeds, precious metals, industrial metals, soft commodities, livestock. You can see all there, right? Okay. If you follow me for a while, I cover this. So I like to play the game every month when we have the CPI, not every month, but once in a while, and try to predict whether the CPI is going to come in line, hotter or cooler than expected. That's the Consumer Price Index. The next one, the May CPI, will be reported on June 12th. So yeah, I'm not going to be here. So that's why I wanted to get this out. I don't have a strong opinion because this is where we closed the month right there. Here you can see I put a little line. That's where we closed April. And so we went down for 2 days there below the closing date. We had a sharp run up, but then a pretty equally sharp fall. That was the close of the month right there. So on balance, again, this is not perfect. And this is very important I say this because this says, again, crude oil is priced in faster than most, but it may be there's some lag. They take the BLS, or whoever calculates the CPI, they do data point. They go around the country and price a basket of goods and services at different points throughout the month. I've looked that up. It's not a spot check. And so, all I can tell you is it is overall was elevated. And now, more importantly, so I'm not going to make a call on I don't even know. I didn't even look to see where the consensus is. The consensus should be, if you're looking at just this, for a gain month over month, because if you look at where we averaged April, we shot up real quickly and then stayed high from this is where we averaged. That was the average for the previous month. So that was an increase in inflation. And if I just eyeball this, I'm going to say that's certainly going to be over there, and that should be above April's number, right? Based on, again, just this. Now, whether it pans out or not. What I can tell you too, turn off all the lines right here, is remember, a lot of these things are lagged. For example, energy, as I keep saying so far in this video, is priced out pretty quick, because that is, if you go, I'm trying to circle that low, it's reflected in the pump. If you see oil shoot up from 70 to 85, $90 a barrel, you bet your bottom dollar that Citgo gas station down the street is going to be quick to raise the gas price at the pump. They're not as quick when crude prices fall. And I know there's a whole crack spread, what the refiners are doing. I get it. But anyway, you know what I'm talking about here. So, they're going to quickly raise prices. Now, where I was going with that is food, grains aren't. So in DJP, we're looking at commodities. I always say this, wheat, corn, soybeans, they can run up 30, 40, 50% in a month or a couple months if they want to, but doesn't mean that the price of a loaf of bread is going to go up, because that's what's in the CPI, not the raw commodity. So, however, with that being said, there is that lag. You continue to see commodities in general go up month after month. So what I'm getting to here is we peaked back in February, and you can see commodities have been hitting this floor, and the trend since mid-February has clearly been higher. So, and sooner or later that's going to trickle its way or permeate its way into the inflation numbers. So as long as this trend continues and we keep putting in these higher lows and higher highs, that's inflationary, and that's not going to help the Fed's case to cut rates, at least not very aggressively. Like I said, I think everyone agrees we'll probably get a quarter point this year, a token quarter point, but wouldn't be looking for a lot more than that, at least until we see an abatement here in inflationary forces. Okay, yeah, I think I'll wrap it up here. We've gone on long enough. I'll cover some sectors, any individual stocks that I've highlighted. Like I said, I got in late yesterday. I think there were a ton of comments from the day I was gone. I haven't gone through those. I haven't had time to enter that post. So do me a favor if I don't get to that. Any updates you want on any individual trades or anything you're watching, throw it out in the comment section below this post. I'll do my best to get to it. And like I said, I'll be here through tomorrow, and then out for on vacation for a couple weeks there, or at least 10 days. This has been Randy Finney with Right Side of the Chart. Have a great